If you want to invest in gold, you can buy a physical bar and lock it in a safe, or you can trade a digital representation of that gold bar. In modern finance, these digital versions are called synthetic assets. They mimic the price of the real thing, but you can trade them back and forth endlessly. In a traditional trade, there is usually a deadline, a date where buyer and seller settle up and hand over the actual asset. That deadline acts like an anchor, forcing the trade price to match the real-world price. But because these digital versions never expire, they have no anchor. Without a deadline, the digital price can just float further and further away from what the real gold is actually worth. Yet, in these markets, that drift rarely lasts long. An invisible algorithm is constantly measuring the gap between the real asset and the digital one. The moment the digital price wanders too far, this mathematical force snaps them back together. Right now, as you watch this, millions of dollars are shifting between traders every few hours, based entirely on this single self-correcting equation. Traders call it the funding rate. You can think of it as an automated financial tug-of-war. It identifies who is pulling the price away from reality and forces them to pay a cash fee to the other side to keep the market honest. Without this unseen heartbeat constantly pulling the strings, the digital market would lose its connection to the real world entirely. This diagram shows how that tug-of-war works. That static vertical line in the center represents the real-world price, what the physical asset is actually worth right now. The thick horizontal rope crossing it is our digital asset. Sometimes a wave of optimism hits the market. Too many buyers start betting the asset will go up. Their collective buying pressure starts to drag the rope over to the right, stretching the digital price higher than the real-world value. To fix this, the system applies a penalty. The buyers, the ones pulling the rope to the right, are forced to pay a cash fee directly to the sellers on the other side, just for the privilege of keeping their bets open. The exact opposite happens during a panic. If everyone rushes to sell, the overwhelming selling pressure drags the rope far to the left, pushing the digital price well below reality. Now the penalty reverses. The sellers who are holding the price down are forced to pay cash directly to the buyers. The further the crowd pulls the digital price away from the true center, the heavier the financial penalty becomes for whichever side is winning the tug-of-war. Imagine a referee stepping into a sports arena and offering you free cash just to pick up a dropped rope and walk it back to the center line. You would likely take that deal every time. In finance, the people taking that deal are called arbitrators. These are opportunistic traders and automated bots that scan global markets all day long, specifically to collect those funding penalties. This is an arbitrage loop. The trader will simultaneously buy an asset in a cheaper market and sell that same asset in a more expensive market, locking in a profit from the price difference. As these traders rush in to grab that profit, their activity naturally forces the two prices to balance out. Simply by chasing a gain, they pull the digital price back into alignment with the real world. This system doesn't rely on anyone's help. It uses the profit-seeking behavior of traders to perform the vital work of keeping the market stable. Widen the lens and you can see this mathematical balancing act happening on a global scale. Most of the industry operates on an 8-hour cycle. This funding window acts as the consistent heartbeat for the entire digital market. Every 8 hours, billions of dollars shift between accounts across the globe. The tension is settled, the majority pays the minority, and the price is reset. The process is completely automated. The code executes the transfers, keeping prices locked to reality without the need for human managers or traditional deadlines. When markets are steady and money is moving normally, this cycle keeps billions of dollars in sync across the globe, entirely on autopilot. But what happens when the financial rope is suddenly and violently yanked far beyond its intended design limits? Imagine a sudden global economic shock hitting a market where thousands of traders have used borrowed money to multiply their bets. In a sudden crash, the automated funding rate cannot move fast enough to stop the chaos. The financial penalty becomes too small to push the crowd back to the center. When that inevitably happens, the very same heartbeat that usually stabilizes the market transforms into a completely lethal trap. Next time, we step inside the danger zone to see how this trap triggers a chain reaction that forcibly closes out thousands of trades at once, wiping out millions of dollars in a matter of seconds.